An emergency fund has a strange return profile. Most of the time, it looks like dead money. It sits there, earning less than stocks, less than real estate, less than almost anything exciting, but during the wrong month, a layoff, a medical bill, a market crash. That same boring cash can prevent a forced sale, a credit card balance, or a retirement account withdrawal. So the real question is not, should cash maximize return? The real question is, how much insurance do you need before the insurance itself becomes too expensive? Today, we model the difference between 3 months, 6 months, and 12 months. By the numbers. The mistake is treating an emergency fund like a bad investment. That is the wrong benchmark. A fire extinguisher does not look useful every day. Insurance does not look profitable every month. The emergency fund is the same kind of tool. It buys liquidity at the exact moment liquidity becomes expensive. If you do not have cash when a shock hits, you have to create cash by borrowing, selling assets, or delaying bills. Those are not free options. They are hidden costs that only show up under stress. This is not an abstract finance problem. The Federal Reserve Bureau Reserve's 2024 Household Survey found that 63% of adults could cover a $400 emergency with cash or equivalent, but only 55% said they had enough emergency savings to cover 3 months of expenses, and 30% said they could not cover 3 months by any means. On the job loss side, BLS data for March 2026 showed that the median unemployed worker had been jobless for 5 weeks, but the average duration was 3 weeks, because the tail is long. About 1/4 of unemployed people had been unemployed for 27 weeks or more, then had medical bills. KFF's 2022 Healthcare Debt Survey found that 41% of adults had some debt caused by medical or dental bills. And Vanguard's 2025 Emergency Savings Research links short-term liquidity to lower financial stress and less retirement account leakage. The emergency is not one scenario. It is a cluster of scenarios. Let's build the model. BLS consumer expenditure data show average annual spending per consumer unit in 2024 was about $78,535 or $6,545 per month. But in a real emergency, most households cut discretionary spending. So this model uses a $4,000 monthly essential spending budget. That gives us 3 cash targets. 3 months is $12,000. 6 months is $24,000. 12 months is $48,000. The question is not which number sounds responsible. The question is what each number protects against, and what each number costs. Start with a small shock, a $2,000 emergency. If you have the cash, the cost is $2,000, and then the job is rebuilding the fund. But if you borrow it on a credit card and repay it over 12 months at the Federal Reserve Bureau Reserve's February 2026 rate for accounts assessed interest, 21.52% APR, the payment is about $187 per month, and the interest is about $241. The point is not that every emergency becomes credit card debt. The point is that the first layer of cash can have a very high avoided cost return because it prevents small shocks from becoming expensive debt. Now, make the emergency bigger, job loss. With no replacement income, the math is brutally simple. A 3-month fund lasts 3 months. A 6-month fund lasts 6 months. A 12-month fund lasts 12 months. But real life is more complicated. Some workers qualify for unemployment insurance. Some do not, and benefit levels vary by state and income. The Department of Labor's unemployment insurance dashboard showed an average weekly benefit of $480.62 for the 12 months, ending March 31, 2026. If that average benefit applied, it would cover about $2,083 per month, leaving a cash gap of roughly $1,917 against a $4,000 emergency budget. In that scenario, 3 months of cash lasts about 3 months. 6 months lasts about 12. 12 months lasts about 25.0. So the same cash balance can mean very different runway depending on income replacement. The most dangerous version is when personal risk and market risk arrive together. Job losses often cluster around weak economies, and weak economies are exactly when portfolios can be down. In 2008, Damodaran's historical return data shows the S&P 500 total return was minus 36.55%. Suppose a household needs 6 months of expenses, or $24,000. The 6-month fund covers it without touching the portfolio. The 3-month fund covers only $12,000, leaving a $12,000 shortfall. If the portfolio is already down 36.55%, raising $12,000 requires selling assets that were worth about $18,913 before the crash. That is the hidden value of cash. It does not just pay bills. It protects the compounding engine from being interrupted at the worst possible time. But there is a second mistake. Assuming more cash is always better. It is safer, but not free. In our model, moving from 6 months to 12 months means holding an extra $24,000 in cash. Using 3.6% as a simple annual cash return proxy, roughly anchored to short-term Treasury bill yields in early May 2026, that $24,000 becomes about $69,343 after 30 years. If the alternative portfolio compounds at 6%, it becomes about $137,844. That gap is about $68,501. If the alternative return is 8%, the gap becomes much larger. If the alternative return is only 4%, the drag is small. So the cost of a 12-month fund depends on the return spread between cash and the assets you are not buying. So the answer is not 3 months or 6 months or 12 months. The answer is risk-adjusted cash. A stable dual-income household with low fixed costs, strong insurance, and flexible spending may not need the same cash buffer as a single-income contractor with dependents, high rent, a high deductible, and volatile income. A household with very high-interest debt might value the first few thousand of cash differently from a household with a large taxable portfolio. And psychology matters. If a bigger cash cushion prevents panic selling during a crash, it may be worth more than a spreadsheet says. If too much cash becomes an excuse to avoid investing for years, it may quietly reduce long-term wealth. Here is the clean framework. 3 months is not wrong. It is a smaller insurance policy. It may handle many small shocks, but it can fail during long unemployment or a market crash. 6 months is not magic. It is a wider buffer that protects against more severe income interruptions. 12 months is not automatically excessive. For some households, it buys psychological and practical resilience. But it also creates a larger cash drag. Emergency savings is not about maximizing yield. It is about preventing bad timing from destroying good assets. The goal is not to hold the most cash. The goal is to hold enough cash that your long-term plan does not have to be liquidated during a short-term emergency. This is education, not financial advice.